Prasun Gajri, CIO at HDFC Life, is joining us on the show this afternoon. Prasun, a very good afternoon to you. What's the call now at HDFC Life in terms of where exactly you're turning overweight versus where you see the risk appetite reducing?
Well, it's a mixed bag out here. Very clearly, I think the market is facing both a certain amount of negative momentum as well as, but at the same time there are positive signs which are also emerging. So I think from our perspective it's a bit of a range bound market. Clearly on the positive sign is the fact that India is relatively isolated in the global trade war scenario. The interest rate cycle is clearly benign, inflation remains low, rupee remains stable, and crude, despite everything, is still not a worry for the Indian economy. So given this and the fact that you have a new government in place who will be willing to look at growth as an imperative, that makes people positive in the market. Having said that, this is more the big picture, but if you look more at the micro, I think sectorally we are starting to see, not just right now, but over the last few months, slowdown emerging across various sectors. The NBFC related issues and the after impact of that is still very much visible, and we don't really have the end situation in sight at this point of time on that. So put both these things together, very clearly one would want to believe that this is a market which is frankly not going anywhere. It could be a period of low returns from the next 6 to 12 month point of view. Having said that, given the positives which I talked about, I also don't believe there is anything significantly negative being built in the market. So therefore we would want to remain invested in this market, not to be out of it. Clearly, but one would want to play it in a slightly different manner than possibly if the growth imperative, especially on the consumption side, was different. So I think that is the call of more of a range bound market, possibly single digit returns over the next 12 months, and manage the portfolio accordingly.
Okay. The other one is the private sector banks, one bank being Axis Bank, and not just being stock specific, but aside from the fact that now they're looking to raise funds, within the private sector bank, a few of these names have started to pick up interest in a big way. One, obviously, brokerages have turned very positive on Axis Bank. IndusInd Bank has started to recover post its Q4 numbers. How would you play this space? And if you want to talk about it in any individual bank from within this pocket?
I will not want to talk about individual banks, but let's look at the sector as a whole. Clearly, the larger private sector banks are in a sweet spot. One, clearly their troubles on the asset quality side are behind. They are well capitalized and their ability to raise funds is not questioned at all. On top of that, they are gaining market share. So even if the credit growth is not very high, most of these banks will be able to do pretty well in terms of growth of credit, because the NBFCs are clearly losing market share. The PSU banks still continue to lose market share. At the same time, the pricing power is still with them. And therefore the ability to kind of make decent margins on incremental lending is also fairly strong. So I think there is a concentration of business which these banks will garner. So at this point of time, and the credit cost over the period of the next 2 years will keep coming off for some of the banks which had these issues. So we remain fairly positive on the entire private banking space. Yes, one would want to be a little bit choosy in terms of which ones, but overall the space looks fairly exciting to us from the next 2 to 3 years point of view.
Prasun, you highlighted the macro environment and keeping all that in mind, and economic slowdown is pretty much pronounced now after we've received the latest numbers, the growth numbers. Keeping all that in mind, in 11,850 where Nifty is trading, it's because a few stocks. So the rally has been polarized because the gains we've seen for stocks like HDFC Twins, Bajaj Finance and TCS, and which have contributed the most. What I want to know going ahead, should investors continue to take refuge into quality where there is more of earnings predictability, because the broader markets, they continue to underperform?
Yeah, fair enough. So I think the point is that over the next 12 months, you would want to take refuge in stocks where the earning trajectory is by and large stable, and people are therefore respecting that and not really bothering too much about valuations. So, but that is, in our view, a little bit more short-sightedness, because that could change. So one would want to kind of, while focus on these kind of stocks, which is quality, because that is what is likely to fare well in this volatile phase, but at the same time manage to have a more diversified portfolio and look for stocks which have corrected, where the earning trajectory is reasonably good and the valuations have come off, but at this point of time market is not really looking at that. Try and identify some of those areas as well. So in our view, it has to be a combination of both these quality stocks as well as stocks which we believe have corrected significantly from the peaks and are looking better from the next 2 to 3 year point of view. They may not necessarily perform in a very volatile market, but as we get out of that, they will do well. So for us, it's more of a combination and continue to maintain a fairly well diversified portfolio across sectors and stocks.
Prasun, stay on with us while we address some important news. Axis Bank management will seek board approval to raise up to $1.3 billion very soon. The private sector lender under Amitabh Chaudhary is set to have talking to potential advisors. Anto Anthony of Bloomberg News joins us now on this exclusive story. Anto, tell us what details are you gathering, and is there any timeline that you've also gathered for this fundraising plan?
That's right. So Axis Bank management has been meeting with potential advisors for a stake sale, which could raise about $1.3 billion. We don't have a timeline as of now, but they have been assessing the kind of interest that a share sale like this could get. Also, we are expecting the bank management to seek a board approval for the share sale as early as next month.
This is something that is obviously going to help in the internals of Axis Bank as well, right?
Yes, this will give a boost to the capital adequacy ratio of the bank. As you know, among the top 5 private sector banks in the country, Axis Bank has the lowest total capital adequacy ratio. So at a time when the shadow banking crisis is worsening, the bank is looking at garnering a better market share and boost loan growth through this capital.
And what would be the mode of fundraising?
It will be a share sale to institutional investors.
Institutional investors. Okay, the complete 1.3 will be through that.
Yes.
Okay, Anto, we'll leave it at that. No, thanks a lot for joining us and taking us through those exclusive details where Axis Bank is considering. In fact, it is talking to potential advisors about the fundraising plans. It is looking to raise about $1.3 billion as early as next month, according to Bloomberg sources.
That's board approval.
Yeah, of course, they'll have to take board approval for the same. Prasun, getting back to our conversation with regard to earnings trajectory, which are the sectors now that one should look at. You already highlighted quality stocks should be the one that somebody should keep in their portfolio. But I want to talk about 2 sectors which have not performed well. One of them is auto and the other is pharma. Not just this year. Pharma has been giving you negative returns, I believe, for the last 3 to 4 years. Is it time now to look at these sectors? Are they giving valuation comfort?
Let's talk about pharma first. So I would not look at pharma as one single sector. I think every company has its own nuances, which is true of other sectors as well. But in pharma, I think because each company is at a different phase in terms of the regulatory inspection schedule, what is approved, what is not approved, the kind of business mix each of them has, both in US, India and other countries. So I would take individual calls on some of these pharma companies. Yes, I do believe that some of these names now are looking better than what they were, but will we go significantly overt on this sector at this point of time? I don't think so, because I think some of the concerns which have been there on this sector continue to persist. As far as autos is concerned, while the stocks seems to have stabilized over the last month or so, one would wait and watch to see what kind of growth scenario and growth numbers come out from these names. It has been very difficult period for these companies, but I don't think anyone has any visibility in terms of when the cycle is going to turn for the better for them. So again, while I may nibble at some of these stocks purely because the valuations are becoming more better than what they were before, but I do not think it is the time again to go significantly overt on the auto sector as a whole, because at least as of now there is no data available to support that thesis. So clearly a wait and watch mode on both of them, but there will be individual stocks within both these sectors which we would be overweight on.
All right, Prasun, we'll leave it at that. Thank you so very much for joining us. Really appreciate you taking out the time this afternoon.